Welcome back. Get the show on the road. So we've been speaking about depository institutions and banks. What do they do? Depository institutions provide services such as check clearing, account management, credit cards, internet banking, all of these things. But depository institutions earn most of their income by using the funds that they receive from depositors to make loans and to buy securities that earn a higher interest rate than that paid to depositors. If you are someone interested in money and debate, this is known as it's exogenous. It's an exogenous monetary theory, essentially, a theory of money that is exogenous. And then there is an alternative theory called the endogenous theory, which is slightly different. But we're not going to talk about endogenous theory. But just if you're someone that's interested in these things, then yeah, what we're talking about here is something called the exogenous theory of money creation. So a commercial bank, what do? They place funds that they receive from depositors and other funds that they borrow into four types of assets. They can either keep deposits, so deposits are on the liability side of the bank's balance sheet. On the asset side, what matches those liabilities? A bank can keep reserves in the form of notes and coins, either in their vault or in deposit at the South African Reserve Bank. Or the other kind of asset that they could have that matches their deposits would be liquid assets such as treasury bills, which are issued by the government, and as well as other kind of very high-grade commercial paper. They can also have investments in longer-term bonds to government or any other really, really let's say low credit risk institutions. And then finally, they have loans that are commitments of fixed amounts of money for agreed upon periods of time. So in other words, they can also have commercial loans to, you and I, firms and households that want to just conduct ordinary commercial transactions. So why do we have banks? Why are they useful? They do a couple of things. Number one, they create liquidity. In other words, if you don't have money and you want to buy something, you can get money through a depository institution like a bank. So they create liquidity. Creating liquidity meaning that you can go and basically put yourself into a debt position. Okay? So in other words, take out a loan and you will get cash, and you can use that cash to buy what you want. Okay? So it creates liquidity. You can convert your debt into money that you can buy something with. Number two, they pool risk. So by getting a whole lot of different loans together on their balance sheet, they can diversify the risk. By diversifying the risk, it means that any default risk is minimized, or the cost, shall we say, of a default risk is minimized. And if they lower the cost of a default risk, they can also lower the cost of borrowing. So if you want to borrow, you can borrow at a lower rate than you would ordinarily be able to borrow at if you were trying to basically just transact with other people. Okay? By going through a bank, you can get a lower interest rate on the amount that you're borrowing than if you tried to borrow it from other people yourself. And then what they also do is they lower the cost of monitoring borrowers. So if you have a deposit at a bank, you don't have to worry about monitoring whether depositors are actually paying their payments, right? It's not your problem. Okay? The bank takes over that problem. And because they do it with so many different borrowers, any costs incurred in monitoring borrowers basically get split over everyone, and they get expertise, and they can do it at the lowest possible cost. So rather than you trying to go and get money back from someone else, the bank does it on your behalf, and because they do it for so many different people, they can do it at a much lower cost, right? So those are your advantages to having a bank as an intermediary between a borrower and a lender. Regulation also plays a role in what banks can or cannot do and what the costs involved are. And of course, one of the reasons that regulation is such a big thing in the banking sector is because if you have a failure, a bank failure, it has massive effects on the entire financial system. So depository institutions are required to basically, there's a whole bunch of laws that govern what they can do. And one of the things that they're required to do is hold reserves, as well as a whole lot of other very onerous things that they need to do to try and maintain financial stability. Financial innovation as well means that the services that banks and other depository institutions offer are continuously changing. So in pursuit of larger profit, depository institutions are constantly seeking ways to improve their products. So obviously internet banking was not something that existed 10 years ago. No, it did exist 10 years ago. Internet banking is not something that existed 20 years ago. Cell phone banking, not something that existed 30 years ago. Credit cards, those have only sort of really grown in use since, I think, about the 1960s. So over time, the way that we bank or the way that we interact with banks changes, and the types of products that they have changes. So commercial banks then are different to a reserve bank. So what is the reserve bank? Or a central bank? Central bank is basically a bank's bank. So all banks bank with a central bank. And the central bank regulates the nation's depository institutions and controls the quantity of money. So in the same way that a commercial bank controls how much the general public can borrow, right? The Reserve Bank controls how much commercial banks can essentially borrow. And because it controls how much they can borrow, it then controls how much banks can lend to the public. So it controls how much the public can borrow. Okay? So the central bank controls how much we can borrow by controlling how much banks can borrow from the central bank. So what does the Reserve Bank do? What is its goals? What's its purpose? Yes? 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 Great question. Very topical. The central bank happens to be a private institution, okay? Which has caused a bit of a political furore, shall we say, right? To the extent that the public protector, whose name just slips my mind quickly, Mkhwebane, right? Basically told, so I don't know how much you know about institutions of governance and how things work and what the role of Parliament is versus the role of the executive, right? But you can go back to medieval Europe and the kings and the queens and everything, and what Parliament does is Parliament makes rules. It makes the laws, right? So the executive is not allowed to make laws. Parliament makes laws. Parliament is elected by the people, so the people make the laws that govern the people. That's what Parliament does. The king doesn't get to say, oh, this is the new law and I don't give a crap what anyone else thinks, right? That's exactly what a parliament is like. You don't get to make the rules, we make the rules, and we are the representatives of the people. Parliament makes law. That is what we do. So Mkhwebane came along and was like, sweet, I am a section, whatever, what's it called, section, I can't remember the term, but anyway, basically a public institution, and what I'm going to do is I'm just going to make a law. You, Parliament, I'm going to make a law, right? And then, yeah, I submitted this document. And obviously, people are like, I don't know who you think you are, but you don't get to make law. Why do you think you get to make a law? Like, that's not how it works. Parliament makes laws, courts interpret laws, and through their interpretation of laws, the actual implementation of the law takes a specific form, right? But you don't get to make a law, whoever you are. That's what Parliament does. For some reason, Advocate Mkhwebane thought that she could make a law, which really makes you question what she understands about the law. But, and she's an advocate, so anyway, so when the Reserve Bank, so basically Mkhwebane said, right, I'm going to make a law and I'm going to tell the Reserve Bank what it needs to do. And the Reserve Bank was like, no, Parliament tells us what to do, and Parliament makes the law, so we're going to take you to the Constitutional Court to overturn your law, which is not actually a law, really. And Mkhwebane was like, oh yeah, no, it's fine, I'm not even going to oppose your application to the Constitutional Court. So she did not oppose it. The Constitutional Court correctly turned around and said, this is dumb. Yeah. That law is stupid, not stupid, but that's not how we make law, so no, that's not a law. You don't have to do anything that she says in terms of just making a law. So, how does the Reserve Bank then, what is the Reserve Bank? It's a private institution. What is it, is that important? So that was part of Mkhwebane's document that had this law, right? Part of that was like, listen, the Reserve Bank is a private institution and this is BS. Like this, the Reserve Bank should not be a private institution. What do we mean by a private institution? What it means is there are shares in the Reserve Bank and private citizens can own shares in the Reserve Bank. That's what it means as private. Let's then talk about what that means as a practical application. The Reserve Bank as a private entity does not get to decide what it wants to do. The Reserve Bank gets told by Parliament what it must do. Okay? So there's no body within the Reserve Bank that can just decide what it wants to do. It can only do what Parliament gives it a mandate to do. Okay? Mkhwebane wanted to give a mandate to the Reserve Bank directly. And the Constitutional Court was like, you may not do that, only Parliament can do that. Get lost. So the Reserve Bank, even though it's a private institution, cannot do whatever it wants. It can only do what Parliament tells it to do. Okay? Secondly, what does it mean if you have a private shareholder? Well, usually when you have a company, you have a private shareholders. Private shareholders get to vote on how profits get distributed. They get to vote on who sits on the board. They can control who the chairman of the board is, and the chairman of the board appoints the CEO, so they can control the management of the company, right? In the case of the South African Reserve Bank, the shareholders do not get to determine profit distribution, right? All profits of the South African Reserve Bank get paid directly to Treasury, okay? Except any shareholder that owns a share gets paid a dividend. The dividend itself is fixed, okay? In the same way that if you lend money to the government and you buy a government bond, you get paid an interest payment. The interest payment that you get paid is a fixed amount, and the price of the bond will adjust depending on interest rates. But the interest rate that you get paid is essentially, it's determined by government. Government decides how much they're going to pay you as an interest rate. Government also decides what the dividend payment will be on a share on the Reserve Bank, and that share is fixed. So what happens is the price of a Reserve Bank share trades at pretty much the same price as an equivalent amount of a government bond. So you get pretty much the same interest rate that you do on a share in the Reserve Bank as you do in a government bond, which makes sense because the Reserve Bank is actually a government institution, okay? So you have no say as a shareholder of how much you get paid. That's determined by government in the same way that owning a government bond does. So you could buy a share in the Reserve Bank if you wanted to, or you could buy a government bond. It makes no difference to the return you earn. The second thing is, as a shareholder in the Reserve Bank, you get to vote on who sits on the board, right, of governors. But shareholders in the government, in the Reserve Bank, only get to elect 6 board members. The other 7 get elected by the Reserve Bank and the executive. right? So shareholders do not have a controlling share within the Reserve Bank, okay? So although they can nominate people to sit on the board, they have no control over the board, right? Thirdly, the board is governed by a governor who is elected by the president. Okay? So the president chooses the governor, and the governor sits on the board and essentially talks about, well, has to make the decisions that happen within the Reserve Bank, right? So the question is, why is the Reserve Bank independent? I mean, why is it a private institution? And the key reason for it being a private institution is primarily symbolic. And the symbolism is the following. Government spending, so fiscal policy, is determined by the executive. The executive serves for a period of 5 years, okay? Which means that any decisions the executive makes has a maximum 5-year period in which it has to bear the consequences, right? If it gets elected again, that same executive, well, okay, it can be extended to 10 years. But 10 years is the maximum. Okay? The executive is no longer accountable after 10 years. Which means you can make decisions in the economy as the executive, which are good for the economy today and are good for the economy for the next 5 years, but are going to turn the economy into absolute cock in 7 years, right? You won't bear the consequences of that. The Reserve Bank, however, is not an elected body, so it doesn't serve for a period of 5 years. It serves indefinitely. And it serves Parliament. And Parliament is the representative of the people. Okay? I mean, directly. Everyone that serves in Parliament is accountable to the people, in theory. Yeah, doesn't seem to be the case at this point in time. There is Anyway. So the Reserve Bank has a much longer time period. The Reserve Bank can say, okay, fiscal policy actions today are going to be good for today, but they're going to have a problem they're going to cause problems in the economy in 10 years' time, in 15 years' time, in 7 years' time. So we, as the Reserve Bank, are in control of monetary policy, and monetary policy is essentially a counter to fiscal policy if fiscal policy is going to be used in a way that serves a short-sighted executive that doesn't have the best interests of the people in its long-term goal, right? So monetary policy, by being held by Reserve Bank, and Reserve Bank being answerable to Parliament and not being answerable to the executive directly, right, can take decisions that are much longer term than the executive. So what you want to do is you want to make very clear that the Reserve Bank is entirely independent of the executive body. And one way to do that is to say it's a private institution. Symbolically, it's a private institution. Regardless of the fact that it doesn't actually operate as a private institution, it's symbolically a private institution to indicate that it is separate to the executive. It has a different mandate. Its mandate comes from Parliament, not from the executive. What happens when you are not independent of the executive? Well, we've seen things like Eskom, Denel, Transnet. These are all government institutions that have fallen under the sway of the executive and have been used for means that are, let's say, not in the best interests of the people. When you as Transnet sell your, what do they call them? The reserves of oil, they're called, emergency reserves. When you sell your emergency reserves of oil, all of them, the entire, something like 10 billion barrels or something of oil, 10 million, I can't remember exactly what it was. When the price of oil tanks to the lowest that it's been in 20 years, and then the money kind of just disappears, you kind of got to say, well, why did you do that? And the answer forthcoming has been, we're looking into it. We're not sure why we sold, strategic, that's what it was. We're not sure why we sold the strategic oil reserves, and we're not sure why we sold them at an incredibly low price, and we're not really sure where the money's gone, but we're looking into it, right? So that's the kind of symbolism that is captured by the idea that the Reserve Bank is a private institution, right? It answers to nobody but Parliament. That's what it does. And that is why it is private. Is there any like practical value to it being private? No. It just operates just like any other institution, right? But, and yeah, we've seen Treasury as well, also meant to be independent, but yeah. Anyway, great question, very politically relevant. What is the central bank? What are its goals? The Reserve Bank takes responsibility for the following things. Why does it take responsibility for these things? Because Parliament tells it to. Okay? Formulate and implement monetary policy. Issue banknotes and coins. Supervise the banking sector. Ensure the effective functioning of the payment system in South Africa. Act as a banker for the government as well as act as the lender of last resort. What is the primary goal of the Reserve Bank? Its primary goal is to achieve and maintain price stability. Okay? Primary goal. It has a secondary goal, which is also to promote economic growth. Number one, price stability, and if prices are stable, number two, promote economic growth. That's the mandate. How does it do that? It does it by adjusting the quantity of money in circulation, by controlling the interest rate. The structure of the Reserve Bank, it's not owned by government, but it's accountable to Parliament, and the Board of Directors has 15 members. So I might have got my numbers wrong. I said 6 and 7. Okay, so it might be 6 and 9 or something, whatever it is. And one of those members is appointed by the executive. I think 3 of those members are directly appointed by the Reserve Bank. So the Reserve Bank internally selects 3 of the, I think it's 3 members to serve on the committee. The Monetary Policy Committee is the main policy-making organ of the South African Reserve Bank. The Monetary Policy Committee consists of the Board of Directors. I'm not sure if there's anyone else that sits on that or not. And how does the Reserve Bank do what it does? What are its tools? What does it use? The single most important responsibility is influencing the amount of money in circulation, and it has 3 main tools. Okay, 3 tools. First, the required reserve ratio. Second, the repo rate, and third, open market operations. What do we mean by the required reserve ratio? All deposit institutions are required to hold a minimum percentage of deposits as reserves. What is the repo rate? The repo rate is the rate at which commercial banks can borrow from the Reserve Bank. So if you want to borrow money as a commercial bank from the Reserve Bank will charge you something called the repo rate. Repo rate stands for repurchase rate. Open market operations. Open market operations is when the Reserve Bank goes into the loanable funds market and buys or sells government bonds. Okay? It does that to influence interest rates. And here's a brief picture of what that looks like. I just want to see, I put a question here. Yeah. Let's do this question. We'll end the lecture with this question because I think this has been a pretty heavy lecture. Well, no, not really? Okay, whatever. Well, let's do this question. After doing this question, we'll briefly talk about this, and then we'll start next week with this diagram as well. So we'll talk about it a little bit, and we'll talk more about it next week. So here's a question for you. Which of the following actions could the South African Reserve Bank use to combat inflation? So to combat inflation, Tell you, to combat inflation, that means to make prices go down. And the way you make prices go down is to decrease the money supply. Okay? Decrease the money supply. So, with your textbook, and I'll give you a page reference. Page 553. And page 554. But now that I'm looking at it, I think I must actually, let's talk about this diagram first. Otherwise, I think it's going to be just too much for me to ask you to do. Okay, so first I'll talk about this diagram, then we can do this question. Okay? But on pages 53, 54, and 55. What does the Reserve Bank do when it does open market operations? Okay. So here we have the balance sheet of the Reserve Bank, and here we have the balance sheet of a commercial bank. The Reserve Bank is going to go into the loanable funds market, or the bond market, and it's going to buy securities. So it buys securities in the open market. What does it do when it buys securities? Okay? In the Reserve Bank's balance sheet, okay, it's going to purchase securities, which means its assets are going to go up. It's going to hold government securities. It buys security. Those are assets. Are you guys happy with the idea that buying government securities is an asset? If you hold a bond, that's considered to be an asset. If someone owes you money, that's an asset to you. Right? You happy with that idea? So the Reserve Bank buys a government security, it holds a bond, it's like the government owes the Reserve Bank money. Okay? Holds a security. When it buys a security in the open market, though, it doesn't buy that security directly from the government. It buys that security from someone else that was already holding that security. Okay? So the Reserve Bank goes into the market to buy government security, but not from the government. It's buying a government security from someone else that already owns that security. Okay? And the legal entity that's going to own that security, in this case, is the commercial bank, Nedbank. So Nedbank owned a security. It sold that security, not us, to the Reserve Bank. The Reserve Bank bought that security, and it paid Nedbank with money. It said, you give us the security, we'll give you money. Here's some cash. That's not a problem for the Reserve Bank because the Reserve Bank can just print cash. Right? It just prints the money. I want to buy something from you. Okay, hang on. Yeah, here we go. Here's the money. Right? So the Reserve Bank says, okay, we're going to buy a security. But of course, the Reserve Bank is in Pretoria. Nedbank's head office is probably in Joburg, right? So when the Reserve Bank buys the security from Nedbank, it doesn't load the cash into a truck and drive it through to through to Joburg, although the Reserve Bank does do that. The Reserve Bank does haul trucks of cash across the country, and in planes sometimes too. Very well guarded trucks and planes. So it purchases those securities, but instead of just sending the cash directly to Nedbank, remember Nedbank banks with the Reserve Bank. Nedbank has an account at the Reserve Bank. So when the Reserve Bank pays Nedbank, all it does is it says, here we go, I'm going to increase your deposits with me. At any time, you can come here and withdraw cash if you want to, because you've got a deposit account, right? So the Reserve Bank is going to make the deposit account of Nedbank increase. And the deposit account at the Reserve Bank is called a reserve account. So if you have deposits at the Reserve Bank, those are called reserves. Okay? So Nedbank, therefore, when it sells its securities, assets go down. Selling the securities, the securities account goes down, but another asset account goes up, and that asset account is called reserves. It could be called cash if it actually got cash, right? But it's not cash, it's reserves. You happy with that idea? Okay? So these reserves at the Reserve Bank are sort of equivalent to cash. Okay? It's as if Nedbank has cash deposited at the Reserve Bank. Are you happy with that idea? So reserves, when the Reserve Bank buys securities from Nedbank, Nedbank converts securities into reserves. On the other side of things, if the Reserve Bank sells securities and Nedbank buys those securities, then the reserves of Nedbank go down. The securities that the Reserve Bank was holding goes down. And the securities held by Nedbank will go up, whereas the reserves of Nedbank will go down. Okay? Now, here's what's important. Remember that the Reserve Bank has something called the required reserve ratio. So if you have deposits as a commercial bank on your balance sheet, and you have, let's make it 1,000 rands worth of deposits, if the required reserve ratio is 10%, that means you need to keep 10% of 1,000 rand as a deposit value with the Reserve Bank. So if your deposits are 1,000 rand, what is the value of reserves that you need to have at the Reserve Bank? If the required reserve ratio is 10%. You have deposits of 1,000 rand, you have a required reserve ratio of 10%. What value of reserves do you need? 100 rand, exactly. Okay? If you are a commercial bank and you have deposits of 1,000 rand, and you have reserves of 200 rand, that means you've got more reserves than what you need. You happy with that idea? What you can do is you can extend loans, grant another 1,000 rands worth of loans, which would then make your deposits go up by 1,000 rand. You happy with that idea? If I grant a loan of 1,000 rand to someone, it's going to be in the form of a deposit. When I give you a loan for 1,000 rand, you can take that loan, it becomes money for you that you can spend, right? That's a deposit. You get a deposit entry, which can now be spent, okay? So when a commercial bank extends a loan, I'll go through detail how it does this. When it extends a loan, the deposits go up as well. If the if the commercial bank extends another 1,000 rands worth of loans, deposits will go up by 1,000 rand. If you initially had 1,000 rand, now you've added another 1,000 rands worth of deposits. How many deposits have you got? 2,000 rands worth of deposits. What are your reserves at the Reserve Bank? 200 rand. Can you now loan any more money if your required reserve ratio is 10%? No, because if you loan more money, your deposits will go up more, and then your reserve amount at the Reserve Bank will be too small. You get it? Okay? So if you want to lend more money, what you have to do is somehow get more reserves. You happy with that idea? How could you get reserves? Well, for example, if you have securities on your balance sheet, sell those securities, convert them to reserves. If you've got more reserves, what does that mean about your lending? You can now lend more money, deposits go up, there's more money in the economy for people to buy stuff with. Happy with that idea? Okay. Therefore, if you are the Reserve Bank and you want to decrease the money supply, what do? You turn around and you say to the commercial banks, I want you to stop lending money. Okay? But if it's profitable for the banks to lend money, they're probably going to lend money. So if the banks don't want to just stop, what do? Well, you can increase the reserve ratio, right? Now you've got to keep more reserves. Crap, okay? Now it's harder for us to lend money. You can increase the cost of borrowing from the Reserve Bank if you don't have enough reserves by increasing the repo rate, okay? And you can go into the actual loan market, into the money market. You can see, and you can do things like sell securities to the banks to make their reserves go down. Their reserves go down, they won't be able to lend money, right? But you have to make it worthwhile for banks to actually want to buy those securities. So if you're the South African Reserve Bank and you want to adjust the money supply, you want inflation to come down, and if you want inflation to come down, what that means is you want less money, okay? If you want less money in the economy, what should the Reserve Bank do? So, given the discussion on pages, what did I say, 553, right? 553, 554, and 555, which of these things here will make money supply go down? Is basically what this question is asking. Okay? Homework. Well, you can discuss it for 5 minutes, and then we can call it quits.